In 2001, one of the most powerful companies in America collapsed almost overnight. Enron was once valued at more than $70 billion. It was praised as one of the most innovative companies in the world. Wall Street analysts admired it. Think investors trusted it. Employees believed in it. But behind the success story was a financial illusion built on accounting manipulation, hidden debt, and corporate deception. When the truth finally emerged, billions of dollars vanished into thin air. This is the story of how Enron fooled Wall Street. Enron began its life as a traditional energy company. It was formed in 1985 through a merger of two natural gas pipeline businesses. At first, the company focused on a very straightforward job, transporting natural gas across the United States. But during the 1990s, Enron transformed itself. Its executives wanted something bigger, something more exciting. Instead of simply moving energy, they began trading it. Electricity, natural gas, commoditized. Enron essentially turned energy into a financial product, something you could buy and sell just like stocks. By the late 1990s, the company was no longer just an energy business. It had become a global trading powerhouse. This new identity was all about innovation. Enron positioned itself as the future of energy markets. Executives promoted the company as a revolutionary platform that could trade absolutely anything: energy contracts, weather derivatives, even internet bandwidth. They even tried to create a market for future electricity demand. The company's CEO, Jeffrey Skilling, pushed a strategy he called asset-light trading. The idea was that instead of owning expensive infrastructure like power plants and pipelines, Enron would focus on financial contracts. Investors loved this story. It sounded like the future. As a result, Enron's stock price exploded. At its peak in 2000, the company was worth over $70 billion. But beneath this narrative of innovation, a very dangerous system was developing. To maintain the appearance of constant, rapid growth, Enron relied on a controversial accounting method called mark-to-market accounting. Now, this is where things get complicated, but it's the key to the entire story. Instead of recording profits when the money was actually earned, Enron booked profits immediately based on estimated future earnings. This meant the company could recognize revenue today for deals that might take years to complete, or might not even be profitable in the end. If their projections were optimistic, their profits looked enormous on paper, but the actual cash might never arrive. To make matters even worse, Enron created hundreds of off-balance sheet entities. These were special partnerships designed to do one thing: hide debt. Officially, the company appeared financially healthy and profitable. But in reality, billions in liabilities were being quietly moved into these hidden entities, out of sight from investors. Many of these hidden entities were secretly controlled by Enron executives themselves. The most famous of these structures were known as special purpose entities, or SPEs. These partnerships allowed Enron to shift massive amounts of debt off its main balance sheet. Investors who looked at Enron's financial statements could not easily see the real financial risk the company was carrying. On paper, Enron looked incredibly profitable. But the entire structure depended on one very fragile assumption: Enron's stock price had to stay high. If the stock price ever dropped, the hidden debts would become visible, and the whole house of cards could come crashing down. And in 2001, that's exactly what started to happen. Analysts began questioning Enron's lack of financial transparency. Reports started to surface about complex partnerships and unclear accounting practices. Confidence started to weaken. Then, a major turning point occurred. A whistleblower inside the company, an executive named Sharon Watkins, warned the leadership that the accounting structures were so unstable they could lead to a massive public scandal. Shortly after, investors began to lose trust. Enron's stock price started falling, slowly at first, then rapidly. And once the stock declined, the hidden debt structures began to fail, just as feared. Billions of dollars in obligations suddenly appeared on the company's books. The illusion was collapsing. Within a few months, Enron went from being one of the most admired companies in America to filing for bankruptcy. Investors lost billions. Thousands of employees lost their jobs and their entire retirement savings, which were heavily invested in Enron stock. The company that once symbolized the future of business became the ultimate case study in corporate fraud. Executives were investigated and prosecuted. The scandals shocked the financial markets so deeply that it led to new corporate governance laws in the United States. Designed to prevent something like this from ever happening again? But Enron's collapse wasn't just about clever accounting tricks. It was about unchecked power and weak oversight. The warning signs had existed for years. But investors were so in love with the narrative of growth and innovation that they ignored them. Growth masked risk. Innovation masked complexity. And complexity masked outright deception. The Enron scandal remains one of the clearest reminders in financial history. When transparency disappears, trust eventually collapses. And in markets built on trust, that collapse can happen very, very quickly. Thanks for watching. If you found this story interesting, be sure to subscribe for more deep dives into the world of business and finance.